What does the Taylor rule tell us about where rates could be headed? The Taylor rule is a monetary policy guideline for central banks to adjust short-term interest rates in response to changes in inflation and economic growth. This is what a traditional Taylor rule with some tweaks for the exchange rate would look like. In simple words, this rule sets rates based on how far inflation and GDP deviate from their respective targets, with equal sensitivities attached to both variables. A forward-looking Taylor rule is then built using the central bank's own forecasts of inflation and growth. A forward-looking Taylor rule using the RBI's own current CPI and real GDP growth forecasts look like this. And another built for the US based on market forecasts look like this. Before we get to what the Taylor rule model tells us, it is important to keep in mind that one must interpret these forecasts directionally and not in exact terms. The RBI's April 2026 forecast imply that the repo rate stands just under 6% by the end of the current fiscal, like seen here. The Fed funds rate, on the other hand, is expected to stand at 4.6% by March 2027. As things stand, repo forecast of 75 basis points above the repo appear exaggerated, but directionally realistic. The forecast for the Fed funds rate, however, is incomprehensible given that the markets are expecting only a single rate hike probability even further into July 2027. Markets are waiting to read more into the new Fed Chair Mr. Wash's commentary apart from a nuanced inflation approach delivered during his swearing-in ceremony. We expected crude price moderation to start sometime in June this month, in a sustainable fashion. If this moderation plays out, the key stress point for India inflation would be only the extent of rainfall deficiency.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.